It's a pleasure to welcome you back to another edition of Chicago's Legal Latte. Hi, everyone. I'm Jim Mitchell, and today we are going to dive into a topic really we haven't touched in the years that we've been doing this podcast, and get a look at perhaps something that's going to be of great interest to owners of small and mid-sized businesses, closely held companies, family businesses, things of that sort. Joining me for the conversation, someone who's been a guest many times, the founder of Lavelle Law, Kerry Lavelle, is with us today. And Steve Schoenbrun, who is from Midwest Benefit Consultants. Steve is with us for the first time. So Kerry, Steve, thanks for taking the time today.
Thanks, Jim.
Great to have you guys here. We're going to talk about retirement plans, some things that are going to be very interesting to those types of companies I've mentioned. Steve, when we talk about retirement pools, what are the common ones that are out there in the marketplace today?
The most common is most people are familiar with is a combination of a 401k and profit sharing plan. It's called a defined contribution plan. Generally, it allows for salary deferrals, matching, corporate profit sharing. That would be the most popular. Second to that, then you go into other types of defined benefit plans, cash balance plans, higher tier plans.
Now, companies obviously are offering these types of programs perhaps out of necessity to attract employees. And what is the general purpose? What's the benefit to companies to not only having a plan, but to choosing a specific plan?
The specific plan is really based on the needs of the client. At the most basic level, you provide an employee benefit that many, or in the state of Illinois, all your competitors with over 5 employees have to provide. So at the very basic level, it's providing a benefit to help employees with retirement and to be competitive in the workplace. At the other end of the spectrum is substantial tax deductions at the corporate level with benefits highly skewed to owners and key employees.
Kerry, in your line of work, your firm has done everything from corporate formation for new companies to tax law, managing things of that sort, working with clients to protect their interests. As you work with clients, whether they're new or established businesses, do you see a lot of conversation and a lot of issues that come up around these retirement plans as an important part to a business?
Yeah, I would say when businesses are just starting, truly small businesses, they don't think about it right away. Mm-hmm. If they're well funded and they have a plan and going forward, they will always bring up the topic of some sort of retirement plan. It is critical for keeping talent. It's sort of the right thing to do, and everybody kind of knows that if you want the top talent doesn't want to really wait around and just retire on Social Security. They need another pool of money. And the whole concept of retirement plans is deferring tax dollars today and then taking that money and being able to use it for your retirement and paying tax on it later on when presumably your tax rate is way lower and you have to pay the tax still on the money as you withdraw it for retirement. Everybody kind of knows those rules. And like Steve said, and I couldn't agree more, 401ks are the kind of the most favorite type of plans, but we like Steve and the things he can do for clients because of his ability to create some integrated plans by using more than just a traditional 401k.
And Steve, I want to ask you about that. Are companies bound to have just one type of plan, or we mentioned cash balance, different types of plans? Is there combinations, hybrid models out there?
So in the design process, 401k plans, the maximum you can put away is around at the $70,000 level. So regardless of what level of earnings you have, the government caps how much can go into that type of plan. Once you want to put more money than that away, you then have to look at a combination of plans. So a 401k is what's called a defined contribution plan. It literally defines the contribution you can put in, and it has contribution limits. A cash balance plan is a defined benefit plan. The contribution can be whatever it takes to fund a benefit in the future. So the contributions are not locked in, and depending on age, the contributions can be substantial. So once your pocketbook goes past the 70,000-ish, you need to look at a second tier plan.
And talk to me about what your company does, Midwest Benefit Consultants, because what I'm hearing is that, first of all, I'm hearing things that I think many business owners don't even understand or recognize as an option. So are you likely to come in and evaluate their current plan? Can companies make changes to those plans on an annual or some other basis? And how do you come in and dissect what they're doing?
Generally, our business is referred by professionals, and if a client has a 401k, most of the business we get, people already have a plan.
Mm-hmm.
And for some reason or another, they need it reviewed. We come in, we review it. Again, depending on corporate earnings, we a lot of times will redesign the 401k plan and posture it to have another plan added on top of it. But just a quick note on 401k plans, because a lot of people do have them. 401k plans are the only plan in existence where money is taken from the employee's paycheck. The rules on 401k plans are far stricter than any other type of plan, but they operate in the real world haphazardly. I have clients that go on vacation, they forget to put their 401k. The Department of Labor is all over 401k plans. When it comes to a cash balance plan that may be complicated for a typical person to understand, from an IRS perspective, it's the simplest plan out there, because an actuary once a year determines a contribution. The money gets put in, the employees have no say in it. There's not a lot to audit on a cash balance plan. On a 401k plan, it's a target for an audit.
Can you give me a little detail about a cash balance plan? What is that? What do you mean when you say that? How does that work?
So a cash balance plan is effectively a plan that says the maximum is about $3 million. So let's say you're 50 years old and you're going to retire based on the plan at 62. You have 12 years. In 12 years, if we want, we can fund the maximum benefit of $3 million. So you can take $3 million divided by 12, offset it by interest. At the end of the day, it's a substantial contribution. If you're 60, if you're 55, retiring at 65, now you have 10 years. There's the amount that can be put into these plans is substantial. The money that goes into 401k, cash balance, all of these plans is the most creditor-proof money in existence, more creditor-proof than an IRA. It's just a really good place for money. And the fact that it's tax deductible means that the IRS is letting you use their money for a number of years to come.
Yeah, if I may, Jim, this is a solution for the business owner that is doing relatively well. He has or she has determined they need $150,000 to $200,000 or $300,000 to live on, and yet the company is making more than that. And that client will come to me and say, I don't want to pay tax on this overage that I am not going to use right away. Mm-hmm. And enter Steve, and he comes up with solutions to defer the tax on that money and prepare it for a retirement. It really works. It's the thing that most successful business owners need to look at in all of their the profile of how the company is being run.
If you look, just to interrupt for a second, if you look at a typical service business, my manufacturing clients, whether they have heavy retirement plans or not, they'll sell their business for 12 to 15 times earnings, and their retirement is set. For this classic service business, a doctor, a lawyer, those people are high earners, but the value of their business is non-existent. There's nothing to sell. Mm-hmm. So for people that make money but don't necessarily have value at the other end, it's important for them to consistently save throughout their working career. That's what creates wealth for them. What creates wealth for manufacturers selling the business.
Business assets of the business. We're flying through this conversation today with Kerry Lavelle and Steve Schoenbrun. We want to get as much in as we can over the next few minutes. We'll give some phone numbers before we let them go. But Steve, if I can maybe simplify and tell me if this is really on track, what we're really looking at here is an opportunity for a successful business owner or group of owners to utilize the return from their company to continue offering a solid plan for their employees, but to sort of skew those assets to allow them to have a larger portion of that retirement pie. Is that a accurate description?
The way the code sections are written allows for leveraging. When you give your employees $1, depending on age disparity, you can get $5, you can get $10. Those leveraging is available in 401k plans. It's available in cash balance plans. Where it works extremely well. It doesn't always work. Until you take a look, you don't know.
And you mentioned in our discussion prior to this that the IRS looks kind of favorably, and that there are specific rules in place, and if all the rules, this kind of gives you a path that the IRS isn't really going to bother with.
Every qualified plan is submitted to the IRS. The IRS approves it or doesn't approve it, but they all get approved or they wouldn't be submitted. So every plan is approved by the IRS, and the approval letter that you literally put in your file says it's a qualified plan as long as it operates in conformity to what you've submitted, which is the problem with a lot of 401ks. They don't.
Mm-hmm.
As long as it operates in conformity, the plan is qualified, the contributions are tax deductible. It's a perfect tax deduction.
I imagine from your end, Kerry, that's just the best thing you could hear in terms of your clients, knowing that you have a plan, you follow it, and you're not going to have concerns down the road with the IRS.
It's certainty. That's exactly right. It's a very comfortable situation for the business owner to have. The approval letter from the IRS almost acts like an opinion letter from the IRS that following the plan as designed gives you tax certainty. And that skewing ability in these type of plans is exactly what business owners want to hear and have, to the extent that they're successful in generating cash. Because no offense to the federal government, people don't want to pay taxes that they don't need to.
Sure.
And the better you understand the rules, the better you can design a plan that optimizes those skewing effects.
And Steve, we're going to wrap up here in a minute, but talk to me quickly about your firm. Do you come in and set these plans up? Do you manage them over time? You're a consultant to, how it's maintained?
Yeah, we do it. We don't have to do everything, but we have the ability to do everything. So
Okay.
we design the plans, we service the plans, we certify the plans. We have the ability to invest the money, but we have clients that have their own investment people that they like. They're free to use them as long as our systems can communicate with theirs, which they do. So we don't sell packages, but we design the plan, we service it, we maintain it, we do all the compliance work. And I've been doing it, I think it's 40 years, since 1979. I have a whole staff, I have people outside, and my son's been with me for 10 years.
A family-owned business, much like we're talking about. All right, before we let you go, Steve, I'm sure we're going to pique interest of people here. How can they get a hold of you to find out more?
Certainly through Kerry's office, but my direct phone number is 847-821-2200.
And Kerry, as always, you've got offices in Schaumburg and Chicago, and as I said, manage business development and tax issues, litigation, so many things. What if someone wants to talk to you, as Steve suggested?
Super easy. Give us a call at the office, 847-705-7555, and you can find us online at lavellelaw.com.
Kerry, Steve, thanks so much for being with us today. Great conversation. And again, let's hope that people follow up and, take advantage of this situation. I appreciate taking the time to educate us a little bit today.
Thanks, Jim.
Thank you, guys.